All right, good morning and welcome. So I promised to make this video to the Telegram community and also for YouTube. So this video is going to be uploaded on YouTube. Now, I want to show you something. And after you see this, you cannot unsee it ever again. So I'm going to show you something real quick. So let me take all of this off. Okay. So let's go to the daily time frame. First, before we start any chart work, I want to show you some illustrations. So when you look at the chart, no, just forget about the chart. Forget anything you think you know about the chart for now. Let me show you something. The market is controlled by an algorithm, by an AI algorithm. This algorithm is called IPDA. Coming. So the market is controlled by IPDA. What is IPDA? IPDA is the interbank price delivery algorithm. This algorithm is what controls price in all markets. As long as it's a tradable asset, it is being controlled by an algorithm. All right. And this algorithm, this AI algorithm, it is impossible to hide its signature from you. So the only way that the signature has been hidden from the general public is through misinformation and disinformation. So going up, we've been flooded by misinformation and disinformation about basically everything, but especially the financial market. Because if you, for some reason, understand how the financial market does work, you would view everything as a scam. Nothing will make sense to you ever again. And after this video, a lot of you will start to have that perspective. There's a lot of you that will go through some existential crisis after watching this particular video. You would go through an existential crisis and you might need to take some time off the chart for you to get back your spark. While some of you will go deeper and seek more information on what I'm talking about. Because this one single video will not be able to cover up everything I would need to tell you about this AI called IPDA. Just imagine other AI models like ChatGPT, Cloud, Gemini, and whatnot. This is an AI model called Interbank Price Delivery Algorithm, IPDA. Now, think of price like, okay, let's make a conceptual idea of price using Michael's, which is ICT's analogy. Now imagine price as a paintbrush. If you've ever painted your wall before, when you dip your brush when you dip your roller into the paint bucket and you slide your paint on your wall higher, you would notice that the paint does not efficiently deliver inside of those pores. There are pores being created when you slide when you just take a quick swipe up. These pores that are being created there, for that your wall to be efficiently painted, you would have to come back into it and then paint it again. Does that make sense? Does this analogy make sense? So because you would have to do that again to make that wall efficiently delivered by paint, for that to be efficiently delivered with paint, you'd have to come back to it and repaint that spot. That is exactly how IPDA works. And now, that's exactly how the market works using IPDA. Now, before going into this, you need to understand the two scenarios in which IPDA reveals itself. First and foremost, the market does one of two things. First, to go to a pool of liquidity, and then the market also goes to rebalance and imbalance. Once you understand these two, the market can only do one of these two things at a given time. It can only go to rebalance and imbalance or pair up a pool of liquidity on the marketplace. To further understand IPDA, you'd have to understand the concept of liquidity. But before we do that, the main reason of making this video is to explain a model, which is the market maker model. So now, I want you to pay attention to this. Now, let's start with this. I'm going to make two illustrations here. You have this. Bear with me. This video might be longer than I intended, but it's good. You're going to find value from it if you take your time to watch it. This is basically what I do when trading. So for those that want to view the chart as a market maker, first and foremost, you cannot beat the market makers. That is impossible to do. What we are currently doing here is understand how the market maker engineers price using IPDA. So because they are controlling the market using this AI algorithm, we want to understand how they are doing it and then participate in their intended move. Imagine if you could predict, or you can know exactly when a geopolitical event, or no, let me not say that, when a politician is about to say something, you're not currently in the room with him, you have no contact with him, so it's not even about insider trading or what have you. Imagine you can just know by looking at a raw, unedited chart. That is what we are currently offering in this community. Knowing how to predict the market before it even prints, before the world wakes up, we already have a prediction on what the market will likely do. And that is how we capitalize on this, because this IPDA is a prediction algorithm. It predicts price. Does that make sense? So because it creates price, it predicts it where price is about to go to next. And that is how the market maker capitalize on this knowledge, by controlling price. So I want you to pay attention to these two images. So as you can see, this image is, you have price going up and then you have price going down. Same thing here, you have price going up, you have price going down. I want you to impute this image inside of your subconscious. Look at it for what it is. Once you understand the inner workings of this image, there is no way for the market makers for the algorithm to for the signatures of the algorithm to be hidden in front of your eyes again. So you'll be able to see IPD for what it is. It's like I was watching Matrix. I was watching the Matrix like 2 days ago, and there was a scene when um Agent Smith shot Neo and Neo died. Then in the real world, Trinity kissed Neo, and then in the Matrix, Neo woke up. Immediately, Neo woke up and he was looking at this agent and also looking at the walls of the apartment they're currently in, the hallway of the apartment they were in. He could not see them as agents again, or like the human form in which they were trying to make the people of the Matrix see them as. He was seeing them as codes. He was seeing them as zeros and one. He could see their silhouette forms, but in zeros and one. He could see the walls of the matrix of the apartment hallway they were in. He could see it as zeros and one, and not as wood or bricks or what have you. He was seeing them as zeros and one. And after this video, you will not be seeing the market as just lines going up and down or candlesticks going up and down. You'd be seeing it as zeros and one, exactly how the this AI, this IPD sees the market. And because I'm talking about AI, a lot of you think you need to learn how to code or whatever for you to do that, but you do not need that. You just need to understand how this algorithm engineers price and delivers price. Back to these images. When price is going higher, this is a buy-side delivery. What is it delivering to? It is going higher to rebalance an old imbalance above the marketplace, or to pair up liquidity at the marketplace. So what type of liquidity? You have old highs or old lows, previous days highs, previous weekly highs, previous monthly highs, and what have you. These highs are where you would have resting orders. There is always resting orders in the marketplace. There is always people willing to buy below these lows. When a low is created in the marketplace, there is always somebody that wants to buy at this low. And the market only needs one contract, just one single contract to execute. It doesn't matter the number of buyers or sellers that come into the marketplace. It doesn't matter. The market just needs one contract, just one buyer wanting to buy below these lows. Yeah, his orders will be placed here. Does that make sense? And now there's always sellers or buyers. There's always orders above the marketplace and below the marketplace, no matter how long the time frame has been or how short the time frame is. Whether you're talking of a 5 seconds chart or you're talking of a 3 months chart, there's always a willing buyer in the marketplace, either a willing or an unwilling liquidity. So above these significant highs, whether a session high, a previous day's high, a previous week's high, or a previous month's high, there's buyers there. These buyers that place their stop losses, their stop loss or whether entries above the marketplace, they will act as buy stops. So they will act as buy stops above the marketplace, and you would have sellers below the marketplace. Yeah, there are traders that would want to see this low broken and act as a support broken, turn resistance, or whatever, or they're trying to buy or they're trying to sell because their initial view of the market is wrong. Earlier, I talked about disinformation. This disinformation has been purposely put out there in the world to confuse everybody, because if you understand how the market works, there's no way for you to profit off of it. So above the marketplace, the liquidity above the marketplace is called buy stops or buy side liquidity. And the liquidity formed below the marketplace, that will be placed below the marketplace, is called sell stops or sell side liquidity. I'm going somewhere with this. So this is it. So the market goes to pair up liquidity. When it's going up doing the buy side delivery, it is going to pair up buy side liquidity or buy stops. They are basically the same thing. And when it is going down doing sell side delivery, it is not going down because sellers are in the market. The market does not care about sellers in the market. The market, it doesn't even know who is trying to sell. It doesn't care who is trying to sell. IPDA say it's time to deliver lower. It's time to deliver to sell side. Doing this sell side delivery, price is going for sell side liquidity. Does that make sense? So this is price doing one of its two things I mentioned earlier, either going for buys, either going for liquidity at the opposite side of the market or to pair up an imbalance. I talked about the paintbrush analogy earlier. When the market quickly moves, when you quickly move your paintbrush to a one-sided direction, let me use here for it. When you move your paintbrush higher, doing this move higher, there will be pockets of paint that has not been delivered inside of this move higher. At the future time, maybe in the next 5 minutes, 1 minute, 2 months, or what have you, at the future time, price will come back into this range from this high to this low. Inside of this range, price will come back into it to deliver sell side delivery before continue going higher again. During this time, this paint higher, this painting higher and the scrub going lower, it has made this range from this low to this high a balanced price range. Balanced price range in the sense that it has efficiently delivered both buy side delivery and sell side delivery inside of this pause where there is inefficient delivery of paint inside of it. Don't worry, you will understand this clearer when we go into chart. I'm trying to paint this picture inside of your head first before I go into the chart work. Now, as you can see, this is price creating buy side delivery and sell side delivery. Also this buy side delivery and sell side delivery. Why is this not a straight line and this not a straight line? Because price will keep offering a discount for buyers when it's going higher, and it will keep offering a premium for sellers when it is going lower. It will continuously offer premium as it's going lower, because when it is low here, it is extremely at a discount, not extremely, sorry, it is at a discount compared to this high where it started. So for it to be at the premium, it will create a new range, which is this candle high to this candle's low, and then trade above the midpoint of it. The midpoint is equilibrium, and above that midpoint is premium. So price has now created a new range, which price trades to a premium and then goes lower. You have this. Now, the next thing I would want to talk about is premium and discount, and then we'll go into chart work. The chart work will be quick because I expected you to have these diagrams I just drew ingrained into your head. I'm not the best when making illustrations like this, especially using a trading view platform instead of an actual editing software. But I want this video to be as raw as possible. That is why. Alright, so the next topic on our agenda is premium and discount. Remember the PDRA matrix. If you are watching this video, I take it you already understand what the PDRA matrix is. If not, I would advise you to check other videos in this channel after watching this, because to understand premium and discount, it is beneficial if you understand the PDRAs. So when you say something is at a premium, what does that actually mean? If you are going to buy a laptop and you're being told the laptop is currently at a premium price, would you like to buy it? Doesn't make sense. Doesn't make sense to buy something that is expensive, that's at a premium price. Use that same logic for when you're going to sell your item and they tell you, let's say you have like 10 ounces of gold and you want to go and sell your gold, and they are offering you a discount price for your gold. It doesn't make sense. So you will not sell at a discount the same way you will not buy at a premium, same way the algorithm does. What IPDA does, this AI that controls price, is that when it wants to buy, when it wants to go for buy side delivery where traders will participate as a buy, it will go to a discount. It will become cheap for smart money to participate. So smart money will buy at a discount and they will sell when it is at a premium, when it's expensive. So they will make more profit. When they buy at a discount, they're buying at a cheaper price. And when they sell at a discount, when they buy at a discount, they'll make more money. And when they sell at a premium, they'll make more money. Does that make sense? So the same thing with the algorithm. You'd have to understand the PDRA matrix. So I would go deeper into the premium and discount, where we go into the chart work. First and foremost, let's start with the daily time frame. Top-down analysis. We're not going to spend too much time here on top-down analysis because what I want to show you is the mathematical model. Now, I said price does one of two things. Goes to rebalance, goes to pair up a liquidity on the opposite side of the market. Here you have sell stops resting below the marketplace, which is sell side liquidity. So when price was above this price here at June 2nd on Tuesday, during this time, there are traders that are placing a buy orders here, or traders that have moved their stop losses below this low or just above it. So they are already willing participants already in the market even before price opens at Wednesday's trading, June 3rd. So you see the logic I discussed earlier. And if you can look at your left hand side here, you'll see an imbalance here. And when you look further left, so your left hand side, you'd see an imbalance here from this candle's high to this candle's low. Remember what I talked about when you paint higher, price will leave pockets of imbalances when you are applying a paint to the upside at a future timing price. So you're applying a paint to the upside from here to here. Let's use here. At the future timing price will come for the imbalance that are resting inside of this pause, because there will be places on your wall that will be left unpainted. So price will want to come back to it to offer sell side delivery to rebalance the imbalances here. And that is what price did here. Now, this from this candle's low to this candle's high, this now has been balanced. Same with this. Does that make sense? I hope I'm clear enough. Let's continue. Now, because I am seeking price to come for these lows here, I'll go into the market from Wednesday's trading after price drop lower. Going into Thursday's trading, I am seeking continuously lower prices to liquidity pools, which is sell side liquidity, because now we're looking for sales. So we're looking for price to offer sell side delivery into sell side liquidity, and also PDRAs, fair value gaps, imbalances on the discount side of the market. So this year you can see this, but I'm not going to talk about this now. I'm just focusing on this. This imbalance now is on a discount, and we are currently at a premium. So we sell from this premium and we're trying to cover up at a discount PDRA. So we're going to buy our sell position below this sell side liquidity pool inside of this imbalance here. Now, going into the daily chart, the topic of discussion for today. So if you have been watching from the higher time frame, so if you've been watching from the beginning of this video up until this point, you are part of the few that are going to take time to actually study this algorithm that we've been talking about, which is the IPDA, because it is a difficult task. It is stressful. It's not something easy. It won't come to you just like that. You have to go search for it. And that is how IPDA works. That is the deciding factor if you're going to be profitable in this or not. So the New York session opens at 9:30 a.m. Yeah. So we opened here at 9:30 a.m. and then price starts rallying higher. This is the 10th of June 2026. And just below it, we have this imbalance on the daily time frame. Remember this imbalance we talked about on the daily time frame? This is what we have here. And then you have this clean lows, which is the sell side liquidity pool we talked about that was indicated earlier from the daily time frame. Now, you do not need price to get to your drawn liquidity for it to be profitable. A drawn liquidity is like a magnet. This imbalance that was indicated on the daily time frame, it is acting as a magnet, drawing price towards itself, because it has pause of inefficiently delivered price action inside of it. So for that reason, price will draw towards it. And because you are looking for sell side delivery, you are going to participate in the sell side of the curve, meaning you are looking for a false move. Price will first of all make a false move to bring in buyers at a higher price. So let's go into it. remember this daily imbalance, which is our door on liquidity. I have this sell side liquidity pool here on the daily time frame. The market opens at 9:30 a.m. New York time. If you're watching from anywhere in the world, I would advise you to change your trading view to New York time zone, ET. So your trading view should be always toggled to New York time zone. That way you can see what the algorithm is doing from wherever you are in the world. So after price opens here at 9:30, price starts rallying higher. Not just higher to a random zone. If you've been trading for a while or you've been following our previous videos, you would notice where price chased to. Yeah. Let me just show you. No need to be mysterious about that, because I took this trade personally. So we have this imbalance here. Look at this imbalance here. Now, because you're expecting lower prices, this imbalance, you're expecting this imbalance to act as a resistance when price chase to it. Yeah, you're expecting price to resist it and then drop lower to fill this imbalance here. So price will go from this imbalance, use it as a resistance to go for lower prices. Back to what I was discussing here. So trading this type of trading is not for the 100% newbies. If this is your first video coming into smart money concept, you might become confused. You might become overwhelmed with a lot of information. Don't be overwhelmed by that. This video is meant to be packed. It's meant for people that have been watching the previous videos from time onto this point. So if you're watching it for the first time, just take notes, get your journal and take notes, and go into the price action. Go into a body of price action and you practice, you backtest, you look at past data. That is your job. That is what you're going to do. That is what will differentiate you from the general public that they claim 90% of traders lose money. These 90% of traders that lose money, they are not professionals. They are just gamblers, let's say. Now back to this. Remember the diagram I showed you earlier, where we have price going higher and then we have price coming lower. Does anything look familiar here? Does it look familiar? Let me show you. Let's go one step forward. One step further. Let me show you something. Let's go to a line chart. Does this look familiar to what I just showed you from the earlier diagram before we dropped down to this 1 minute time frame? Does this look familiar? Price starts rallying here, down, up, down, up, down. You can see this is the market maker model. Yeah, on the chart. This is currently a line chart. This is still the chart. This is a chart, line chart, not a typical candlestick chart. So this will make it easier. This will make it easier for you to understand the illustration I was trying to make earlier. So you can toggle when you are doing back testing. You can toggle between line charts and candlestick chart to see it clearly for what it actually is. Back to our candlestick chart. Now you've understood. You've seen the market maker models, how price deliver buy side delivery and then offer sell side delivery. When price was going for this buy side delivery, I was talking about where it was going for earlier. Give me a moment. Okay, there's an imbalance here. Also, there's a volume imbalance. When there's a volume imbalance, you include that with your fair value gap. The eye of this fair value gap does not have a volume imbalance. The close of this candle overlaps the open of this candle, so it doesn't have a fair value gap. But this here, you have an imbalance here, so it does not overlap. So you include that as your fair value gap. So going into tangents, this is kind of videos you get when it is not an edited video. Get it as raw as possible. This is not some kind of heavily edited production. I'm being raw and showing you how the AI books price. So this is what I was talking about. Enjoy this out in time. So price chase to that daily fair value gap low, the low of it, and fails to have continuous close above the midpoint of this. So this is price tipping its hand to you that it is interested in going lower, and this rally higher, it is a false rally. It is going higher to bring in buyers. Buyers will be coming into the marketplace thinking it's time for price to go higher. It's time for price to make new all-time highs. It doesn't work that way. Price already has a target, which is a low. So you have this. So at 9:30 open, when price starts this buy side delivery, because you are expecting lower prices going into the marketplace, because from your daily time frame, narrative has been given to you that prices, in fact, seeking lower prices. You're going to mark every day, every PDRA that forms, every PDRA that supports price going higher, you're going to mark that and draw that out in time. So you have this PDRA here. We're going to, you have this, draw this out. You have this fair value gap. You draw this out. You have this acted as an inversion fair value gap to take price higher. And then let's use this. You have this also. Now, this is how I personally trade the market maker model when I'm anticipating a sell side delivery of a market maker model, but price is offering a buy side delivery at this point in time. So during this time, as I'm waiting to see a signature of price wanting to change the state of delivery, I will be marking out the PDRA, on the left-hand side of the market that is currently taking price higher. Now, from this candle's high to this candle's low, every PDRA above it is a premium PDRA. This PDRA is premium. This PDRA is premium. And every PDRA below it is a discount PDRA. And also this lows here, this low at 9:35 a.m. is a discount PDRA. Sales and liquidity pool. Now, when price starts running higher, price leaves relative equal highs here. So, and relative equal highs, you have buy stops resting above them, which is also price and liquidity. So, price rallies higher into it and pair up smart money sell orders. So immediately price starts going above these relative equal highs, smart money will start selling instantly. They'll start selling, anticipating price to go for this sell side liquidity pools, because remember what I said earlier, they are already willing participants in the market already. You don't need to question, who is going to buy your sell orders that you're trying to sell here. No, they are already traders that are going to be all of these buyers here that are seeking all-time highs, new all-time highs. Their stop loss is going to be placed below these lows. And remember, from the daily time frame, we have this fair value gap, which is drawing price towards it. So you see a multitude of confluences. So they are already willing participants here, and prices and the market here. You have resting sell side liquidity, which will act in form of sell stops. So after price paired up this buy side liquidity, and we've noticed that it is time for price to start dropping lower. We wait for set of signatures. What type of signature? You'd want to see these PDRAs on the left hand side of the market maker model. So now this has been indicated as the I, because price fails to trade to the consequent encroachment of this daily imbalance. Remember the daily imbalance here, that we're seeking that daily imbalance to act as an inversion to go lower. Price is showing a bearishness on an unwillingness to trade to it. So for that reason, we've marked here as our high of the day, and then price starts going lower. Immediately price starts going lower, you'd want to look to your left hand side of the chart. Every PDRA that acted as a support taking price higher, this PDRA acted as a support taking price higher, this PDRA acted as a support here taking price higher, as a support here also taking price higher. You'd want them to change their nature from a bullish PDRA offering buy side delivery to a bearish PDRA offering sell side delivery. Does that make sense? I hope you got that. So as you can see, this fair value gap here, it changed its state of delivery. It changed its nature, from a buy side delivery, from offering buy side to now offering sell side. Offered sell side here, offered sell side here, once more, again here, and finally here, and then you cover up below these lows here. You don't need price to come for sell side liquidity here or this imbalance for it to be profitable. But if you hold later on, you can see price does in fact come to this sell side liquidity pool, and then price dogged lower into this fair value gap here. But that is not the scope of this video. This video is not to make you have unrealistic expectation that you're going to hold that long. You just need a low hanging fruit target. What low hanging fruit? You have this liquidity pools here. This is a low hanging fruit. You sell from this imbalance here to this sell side liquidity pool. This is about 172 handles. This is not a 2-handle move. This is 172 handle move. If you are trading a mini, you know how much this is. This is about $3,500 just selling one contract. I'm going to talk about the one contract thing later on in a separate video, how you can easily double up your account just trading one contract, either of a mini or a micro. Or if you're trading a CFD, you can trade a 0.1 lot size or a one lot size. Just trade one, especially when you're just starting. Trade just one on your demo account. Do not go into live trading. Just test this conceptual idea on your demo account. Now we've talked about using the left hand side of the chart to act as an inversion when price starts delivering sell side after delivering buy side. Now use the same logic that I explained how all of this PDRA took price higher. Immediately price starts printing these new PDRAs when sell side delivery it is in motion. When price starts delivering to the sell side, every PDRA that is being formed is going to act as a resisting price from going lower. So let's start. So when price rallied higher here and then drop lower quickly, you have this imbalance here. This is the fair value gap. And as you can see, price used this fair value gap as a support, as a resistance, resisting price from going higher. So if you are selling here, your stop loss will be placed above this candle's high, expecting price to come for this sell side liquidity here, this imbalance here, and also these sell stops resting below here. If you miss this first fair value gap rebalance that was rebalanced there, you wait. Price will at a future time offer a PDRA again. So price drops lower once more and creates a fair value gap, an imbalance. Remember the paintbrush analogy. When just take it like it is now time for you to be painting at the downside of the wall, towards the downside of the wall. So when you scrub your roller lower, you have to go higher. When you scrub your roller and lower, you have to go higher to fill in pockets of price action that was not where your paint did not efficiently deliver to. You want to go back to them and then deliver paint to those places. Price will go lower once more. You go to deliver paint to those places where you know that paint has not efficiently delivered to those points. Go lower continuously, delivering price to these to these places where paint has not been efficiently delivered to. I hope that analogy does make sense to you. So as you can see, when price, and it does all of this at a premium from this candle's high to this candle's low at a time window where we are expecting a significant move in price action. You don't want to study time of day. If you have watched other videos, you would understand the concept of time in price action. So this time window being covered in this particular video is the New York AM open, the New York morning session, which starts at 9:30 a.m. at equities open and closes at 12 noon. This is the New York morning session. This is the time window you want to be studying. So go into previous bodies of price action and then study all of this. Study how price offers a delivery, first stage of delivery, and then offers an opposite stage of delivery. So you're going to see how the algorithm pairs up liquidity and also imbalances. That is all. All of the English I've been speaking is just to tell you that price is pairing up liquidity on buy stops and sell stops and rebalancing imbalances here, and this imbalance here. That is all the algorithm does. And it cannot hide its signature from you. That is one of the beauty of this. It cannot, once you've gone into the chart and you've seen this for yourself, there's no denying that it does exist. Now the next burden does follow you, that you would have to practice, you'd have to study, you'd have to journal, you have to learn proper risk management. All of that lies in your hand. Nobody can control that for you. They can only give you suggestion. I can only give you suggestion on your risk management. Or everybody have different risk appetite. I can be willing to risk $200 in a trade. You can be willing to risk $2,000 in a trade. Every single human have different risk appetite. So your risk profile will be different. But if you are just going into demo with this, I would advise you to try to risk below 1% of your total demo account. Let's say you start with $10,000 demo account. I would advise you to risk below $100 and below, which is 1% of $10,000 paper account. Start with that. Risk just 1%. Even though your risk appetite is high or not, it doesn't matter. When you are learning with a demo account, start with just with just less than 1% of the account. And so if you've watched to this point, I'll give you a gift, which is an assignment. So your assignment is to go from now to the end of the year. Start going into previous 1 minute trading window. Mark your 9:30 a.m. open and your 12 noon. So you mark from that close. You mark from this open to this close. You create a folder in your PC that says first week of June. You're going to screenshot it. That time window, you're going to screenshot it. Label all of the PDRs you can see on the 1 minute. I'm not talking of the daily time frame or anything, just on the 1 minute. Label all of it. Go to Tuesday's trading, the 9:30 to the 12 noon. Indicate all of the PRs you can see. This signature of price offering, buy side delivery and sell side delivery. This is for short. If you are going for longs, you will notice price will first offer sell side delivery first before offering buy side delivery. This same logic works in the opposite side of the market. I'm currently using a sell side delivery for it, a market maker sell model for this illustration. Inverse all of what we just talked about for longs. So you do that every trading day. You can start now. After watching the video, you can start with the previous weeks that has already formed to practice them. But as you are going forward, every Monday at the close of Monday's trading, you're going to indicate the 9:30 a.m. open and the 12 noon close. Have this, save it in your folder and put it in your file in the folder in which you created first week of June. As we enter the second week of June, you create a new folder indicating it second week of June. You do the same thing. Monday, after the Monday close, you screenshot the price action. Do it for Tuesday, Wednesday, Thursday, and Friday, and you save it in the second week of June folder. You create a new folder for the third week of June. You keep on doing this till the end of the year. And if you see something that you find helpful, you find useful, then that is your model. And you can go flourish with that. So I hope you got something from this video. I'll talk to you in the next one. Have a nice day and good luck, good trading.